PayPal processes over $1 trillion in payments every year. It is used by hundreds of millions of people across the world to send money, receive money, shop online, and pay for services. And for most of those people, using PayPal feels free. Sending money to a friend, checking out on a website, receiving a payment for something sold online, the basic experience carries no obvious price tag for the average user. Yet PayPal generates over $25 billion in revenue annually. The money is real, the scale is significant, and understanding where it comes from requires looking past the free surface of the consumer experience to the transaction infrastructure operating underneath it. This is the story of how PayPal makes money, why the fee structure is designed the way it is, and what the business model reveals about the economics of moving money across the internet. To understand how PayPal generates revenue, you need to understand what it actually provides. PayPal is not a bank in the traditional sense, though it holds customer funds and facilitates financial transactions. It is a payment network, an intermediary layer that sits between the buyer and the seller, between the sender and the recipient, and between the consumer's bank account or card and the merchant's account. Every time money moves through PayPal's system, PayPal has an opportunity to charge for the movement. And the structure of those charges, who pays, how much, and under what circumstances, is the architecture of its entire business model. The fundamental revenue mechanism is the transaction fee. PayPal charges a percentage of the transaction value plus a fixed amount per transaction on payments processed through its platform. The exact rate varies depending on the type of transaction, the country involved, the currency being used, and the nature of the relationship between the parties. For merchant transactions, where a business accepts PayPal as a payment method from a customer, the standard rate in most markets is a percentage in the range of 2 to 4% of the transaction value, plus a small fixed fee. This fee is charged to the merchant, not the customer. The customer pays nothing directly for using PayPal to complete a purchase. The merchant absorbs the cost as part of accepting PayPal as a payment method. This is the same basic structure used by credit card networks, Visa and MasterCard, where the merchant pays a processing fee on every transaction and the cardholder pays nothing directly to the network. PayPal built its merchant fee structure to be comparable to card processing costs, which made it a natural alternative for online merchants who were already accustomed to paying processing fees on card transactions. For many merchants, accepting PayPal means accepting one more payment method at a cost similar to what they already pay for card processing, which makes the decision to integrate it straightforward. The consumer-facing fee structure is more nuanced. Most basic PayPal transactions between friends and family, sending money to split a bill, repay a debt, or transfer funds between personal accounts, are free when funded from a PayPal balance or a linked bank account. This free peer-to-peer transfer capability is what attracted hundreds of millions of consumers to the platform in the first place, and what keeps them using it regularly. But when a personal payment is funded by a credit or debit card rather than a bank account balance, PayPal charges the sender a percentage fee. The cost of the card transaction is passed on to the sender rather than absorbed by PayPal. This fee structure encourages users to link bank accounts rather than cards for personal transfers, which reduces PayPal's own processing costs while still generating fee revenue from users who prefer the convenience of card funding. Currency conversion is another significant revenue mechanism. When a transaction involves two different currencies, a buyer in one country paying a seller in another, or a user sending money internationally, PayPal handles the currency exchange and charges a conversion fee on top of the transaction fee. This fee is applied as a margin above the base exchange rate, meaning PayPal buys currency at one rate and converts at a slightly less favorable rate for the customer, keeping the difference. Across the volume of international transactions PayPal processes, currency conversion margins represent a meaningful revenue stream that is entirely separate from the transaction fee structure. PayPal also operates Venmo, a peer-to-peer payment app that is particularly popular among younger users in the United States. Venmo was acquired by PayPal and initially operated with very limited monetization, focused primarily on growing its user base through the social payment experience that made it distinctive. Over time, PayPal has introduced fee-generating features to Venmo, instant transfer fees that charge users who want funds moved to their bank account immediately rather than waiting for the standard transfer window, a Venmo debit card that generates interchange revenue on purchases, business profiles that allow merchants to accept Venmo payments at a transaction fee, and a credit card issued in partnership with a financial institution. Each of these features extracts revenue from Venmo's user base using mechanisms consistent with PayPal's broader transaction fee model. PayPal Credit, a buy now, pay later, and revolving credit product offered at checkout on merchant websites, adds a consumer lending dimension to the revenue model. When a customer uses PayPal Credit to finance a purchase, PayPal earns interest on the outstanding balance if the customer carries it beyond the promotional period, and it earns fees from merchants who benefit from the higher average order values that buy now, pay later financing typically produces. This credit product converts PayPal from a pure payment facilitator into a consumer lender at the point of purchase, adding an interest income revenue stream to the transaction fee base. The Honey browser extension, acquired by PayPal, represents another layer of the revenue model. Honey automatically finds and applies coupon codes on shopping websites and notifies users of price drops and cashback opportunities. The cashback Honey offers, called Honey Gold, is funded by affiliate commissions that merchants pay when Honey drives a purchase on their site. PayPal collects the affiliate commission and distributes a portion of it to the user as Honey Gold rewards, keeping the remainder. This affiliate revenue stream draws on the same consumer shopping behavior that PayPal's core payment business serves, extending the company's ability to monetize e-commerce activity beyond the payment transaction itself. The reason this model works is the network effect that makes PayPal valuable to both merchants and consumers simultaneously. A merchant wants to accept PayPal because hundreds of millions of consumers have PayPal accounts and prefer to use them. A consumer wants to use PayPal because it is accepted by millions of merchants worldwide. Each side of the network makes the other side more valuable, and PayPal collects a transaction fee from the merchant side of every exchange the network facilitates. The larger the network grows, the more transactions flow through it, and the more fee revenue PayPal generates, without needing to rebuild the infrastructure that processes each transaction. The trust dimension is also critical to why the model works. PayPal built its initial reputation around buyer protection, the guarantee that if a purchase went wrong, the buyer had recourse through PayPal's dispute resolution system, rather than being entirely dependent on the merchant's goodwill. This protection was particularly valuable in the early days of e-commerce, when buying from unknown online sellers carried significant uncertainty. The trust that PayPal's buyer protection created drove consumer adoption, which drove merchant adoption, which grew the network that generates the transaction fees. What makes this model scalable is that the payment processing infrastructure handles increasing transaction volumes without proportional increases in operating cost. The technology that processes 1 million transactions a day can process 10 million transactions a day at a fraction of 10 times the cost. As PayPal adds merchants and consumers to its network, and those participants transact more frequently, revenue grows with volume while the underlying cost structure scales more slowly. The fixed cost of maintaining the payment infrastructure is spread across an ever-growing volume of transactions, improving the unit economics of the business as scale increases. International expansion also compounds the revenue opportunity. Each new country where PayPal establishes its payment infrastructure adds a new pool of merchants and consumers to the network, and cross-border transactions between different markets generate both transaction fees and currency conversion revenue simultaneously. A payment from a consumer in one country to a merchant in another is worth more to PayPal than a domestic transaction of the same value, because it triggers both fee categories rather than one. What PayPal reveals about the digital economy is something fundamental about the economics of financial infrastructure. Money moving across the internet does not move for free. Every transfer, every payment, every currency conversion involves an intermediary that provides the trust, the technology, and the regulatory compliance required to make the movement reliable and reversible. That intermediary charges for what it provides. And at the scale of $1 trillion in annual payment volume, even a small percentage fee produces an enormous absolute revenue figure. The transaction feels free. The infrastructure moving the money is anything but.